Every time there's been a backup in Treasury yields, I've spoken to you, your colleagues, Mike Collins, and you'd be a buyer. And I'm looking at things right now, and I'm just wondering if you, Mike, Greg Peters, are thinking the long end is starting to look a little bit vulnerable. Because when I speak to you guys at PGIM, if I ended this interview right now, I'd assume you've changed your mind. Rob, do you think the long end's vulnerable?
You would assume that I've changed my mind. I
would have thought, based on what you've said over the last couple of minutes, that you would think the 30-year and 10-year yields were going higher.
No, I think they just went higher. I think that this is a range trade, and we're probably near the top end of the range. Unless you're going to get a spectacularly large fiscal stimulus post-election that is not going to be well supported by the Fed and ongoing really strong economic growth, you're looking at Treasury forwards on the long bond that are too high. And in the long run, the Fed is going to end up being trapped at zero. They're not going to be going to 2.5% in the next cycle. At the most, optimistic point in this cycle, 5-10 years down the road, I'd be surprised if they got above 1.5%. So I think that we're going to be in a 50 to 100 basis point range. That most of the time when people are taking a level-headed assessment of what's going on out there, you'll probably be in the bottom half of that 50 to 100 basis point range, and that puts us at the top of the bottom half. And so, markets have been very thin. We had that period in June where we spent just a few days higher than where we are now, and then we crashed back down. I think that, we're having a moment of optimism. We have supply coming this week. And as I said, the long end of the market is on its own. But big picture, I think overall the bond market looks very good here. That your global backdrop is yields everywhere else much lower than the U.S. We're not going to be sustainably much higher than where we are now in yields. And there's going to be a lot of conservative money that's going to be supporting all the credit product. So, on balance, very positive, but it's obviously going to be very shaky. The next few months will be a lot of banging around.